Imagine you're driving down the highway at, I don't know, 70 miles an hour. You don't wait until the tires lose traction and you're like actively spinning out of control to suddenly reach over and frantically try to click your seatbelt into place.
Right, because by the time you actually realize you're in a crash, it's too late.
Hmm.
I mean, the physics of the situation have already taken over.
Yeah, you're just a passenger to the momentum at that point.
Exactly. The seatbelt has to be fastened when the car is still safely parked in your driveway, long before you even turn the key.
But, and this is the crazy part, when it comes to money, specifically how we manage our wealth during major market crashes, people routinely forget how the physics of a crisis actually work.
Oh, totally. They try to put the seatbelt on while the car is flipping.
Yes. And so, welcome to today's deep dive. We are tackling a really powerful, honestly somewhat counterintuitive premise today, focusing heavily on the core Wealthnetic mindset. And it's basically this. During major economic disasters, the wealthiest 1%, they don't just survive the chaos, they very often exit the crisis significantly richer than when they entered it.
Which is, it's the exact phenomenon that makes the average person feel like the entire financial system is just rigged against them.
Right. It looks like magic. Or insider trading.
Yeah, it looks like they have a crystal ball or, some secret inside information that warns them to get out before the drop. But if you actually look under the hood of institutional wealth, it rarely comes down to predictive luck.
No, not at all. It comes down to structural behaviors. We're talking about a very specific decision architecture that was built, stress-tested, and locked into place during the really calm, boring times.
The driveway phase.
The driveway phase, exactly.
Wow.
So our mission for this deep dive is to decode this hidden architecture. We're unpacking the structural mechanics of financial resilience and really the underlying psychology of money.
And, we should mention why this matters to the listener right now.
Oh, absolutely. Because you don't need a massive 9-figure net worth or a dedicated family office to build this stuff. You can replicate this exact framework today, scaling it down to protect your own USD portfolio, preserve your options, and honestly, just guard your peace of mind.
But to do that, to really build it, we have to understand that the reason we need these financial seatbelts in the first place, it actually has nothing to do with finance. It comes down to evolutionary biology.
Biology, right. Because
Yeah.
we are dealing with human psychology under just the most extreme cortisol-soaked conditions you can imagine.
Yeah, we're talking primal brain stuff.
Okay, let's unpack this. We have a massive goldmine of research in front of us today to help decode this architecture. We're pulling frameworks from some incredible sources like the book, The Psychology of Money, the Little Book of Behavioral Investing, some really deep dive research from the CFA Institute, the American Century Investments Playbook, and a fascinating breakdown from the 8-Bit Economics video channel.
We also have some structural guidelines from Morningstar and Passive Investing Australia in the mix, right?
Yes, exactly. And the through line across all of those sources is this fundamental shift in focus because we spend so much time debating what to buy, which index fund, which tech stock, is this real estate market good?
Right, the what?
But wealth preservation is really about the decision architecture you build around what you buy.
I really love that phrase. By the way, decision architecture.
Yeah.
So let's start at the very foundation of that architecture, which is the human brain itself.
Yep.
The author of the Little Book of Behavioral Investing introduces this concept of the empathy gap and these two dual systems of the brain.
Oh, this is the Star Trek analogy, right?
Yes. It's such a brilliant analogy to explain why we are literally our own worst enemies in a market crash. It's basically the classic Spock versus McCoy dynamic from the original Star Trek.
Okay, break that down for us. Who is who in our brains?
So neuroscientifically, we essentially operate with two competing systems of thinking. You have the X system, which is the emotional, impulsive, lightning-fast part of the brain. That's Dr. McCoy.
Right, McCoy is all emotion and instinct.
Exactly. It's governed by the limbic system. It
Yeah.
processes information automatically, and it is entirely wired for immediate physical survival. Then on the other hand, you have the C system. This is Mr. Spock.
The logical side.
Very logical. It's
Yeah.
deliberate, it's analytical, and it's rooted in the prefrontal cortex. Spock is slow. He requires massive amounts of caloric energy to operate, and he is highly, highly rational.
And most of the time, when you're sitting at your kitchen table with a cup of coffee on a Sunday morning, looking at a beautifully color-coded spreadsheet of your net worth, you feel like you are Spock.
Oh, 100%. You map out your target allocations, you project this nice conservative 7% compound annual growth rate for your retirement, you look at historical charts of the S&P 500, and you just feel totally rationally in control. You feel in control because, in that low-stress environment, the C-system Spock is actually running the show. But that right there is where the empathy gap creates a fatal blind spot.
So what exactly is the empathy gap, psychologically speaking?
The empathy gap is this well-documented psychological phenomenon where human beings, when they're in a cold, calm, rational state, severely underestimate how they will behave when they are suddenly thrust into a hot state.
A hot state meaning?
Meaning a state of extreme emotional or physical stress.
Ah, Okay. Like that famous quote from a heavyweight boxer, you know the one, right? Everybody has a plan until they get punched in the mouth.
Yes, exactly. That is the perfect way to describe it. You can sit in your living room and confidently declare, like, if a bear attacks me on my hike tomorrow, I will simply stand tall, make myself look big, and yell. Because you read that in a survival guide.
Right, because Spock read the manual.
Exactly. But when a 1,000-pound grizzly actually steps onto the trail 10 feet in front of you, your C system just shuts down completely. Spock leaves the bridge, your X system takes over, dumps a massive amount of adrenaline into your bloodstream, and you just turn and run for your life.
Which is, ironically, the absolute worst thing you can do when facing a bear.
Right, and that is the empathy gap in action. So bringing this back to finance, an investor might write down, if my USD portfolio drops 20%, I will simply buy more index funds because equities are on sale.
Which sounds incredibly rational.
It does. But when the market actually craters, when you log in and see your life savings losing thousands of dollars an hour, and the financial media on TV is screaming about the collapse of the global banking system, the X system completely hijacks your brain.
The inner McCoy takes over.
Completely. The limbic system literally overrides the prefrontal cortex. Evolutionary fear kicks in, and that biological need to run from the bear translates directly into panic, selling everything at the absolute bottom of the market.
Okay, but let me push back on this a little bit just to play devil's advocate here. Because this feels like it could just be an excuse for bad discipline.
How do you mean?
Well, aren't highly educated people or like experienced professionals somewhat immune to this? I mean, if I deeply understand the mathematics of compounding, and if I've studied the complete history of the stock market so I know for a fact that markets eventually recover, shouldn't my intelligence allow my C system to just maintain control?
You would think so, right?
Yeah.
But that is actually the great illusion of Wall Street. Intelligence offers basically zero protection against the limbic system.
Wait, really? Zero.
Zero. And this raises a really fascinating point from the research about how our brains physically process financial loss. The author of the Behavioral Investing book highlights these neuroscientific studies using functional MRI machines.
Okay, where they scan the brain while people do tasks.
Right. And when they put subjects in these machines and simulate significant financial losses, the brain doesn't light up in the prefrontal cortex where we do our math. It actually lights up in the exact same neural pathways that process acute physical pain.
Wait, actual physical pain, like touching a hot stove?
Yes, exactly like that.
Mm.
The brain's pain matrix cannot differentiate between I am losing a massive percentage of my stored survival resources, which is my wealth, and I'm being physically attacked by a predator.
Oh, wow. So the biological threat response is literally identical.
It's identical. So a high IQ doesn't just automatically turn off your nervous system. In fact, there is this really dangerous secondary effect that the research points out. Highly intelligent people are often far worse at navigating this because they are better at rationalizing their panic.
Okay, what do you mean by rationalizing their panic? How does that work?
Well, when their X system screams at them to sell everything to stop the pain, their highly developed C system kicks in, not to stop the panic, but to justify it.
Oh, I see. So Spock starts working for McCoy.
Yes. Spock becomes the PR agent for McCoy's panic. They use their formidable intellect to construct these incredibly sophisticated, data-driven arguments for why this specific crash is fundamentally different from all historical crashes.
This time is different, right? The four most dangerous words in investing.
Exactly. They convince themselves why they absolutely must liquidate their assets immediately. They essentially build this brilliant logical fortress around what is actually a purely emotional decision.
That is fascinating. And here's where it gets really interesting in the context of the Wealthnetic mindset. Because the 1%, the institutional wealth builders who successfully navigate these crashes and actually buy up cheap assets, they know this about themselves, don't they?
They absolutely do. They don't rely on being smarter or braver or more disciplined in the heat of the moment. They assume they will be reduced to panicked animals just like everyone else.
So how do they get around it?
They utilize pre-committed decision architecture. In the institutional world, this is often formalized as an investment policy statement or an IPS.
Okay, an IPS. If you accept the neurological reality that your Spock brain is going to go offline during a crisis, you have to make all of your critical decisions now while Spock is still at the table.
That's the core of it.
Mm-hmm.
An IPS is the ultimate tool to legally and structurally force the C system to stay in control later on. It's a written framework, a binding operational contract with yourself or your wealth manager that's created months or even years before volatility ever hits.
Let's talk about what actually goes into an IPS, because the guidelines we looked at from the CFA Institute and Morningstar really emphasize that this isn't just like a vision board.
No, it's not a vision board at all.
It's not a vague goal like, oh, I want to retire comfortably by 60. It is an incredibly specific, highly mechanical document, right?
It's extremely mechanical. According to the CFA Institute, a proper IPS defines the investor's explicit return objectives, their tax constraints, their liquidity requirements, and a very rigid framework for risk management.
But the most vital component for our discussion today is the rebalancing protocols, isn't it?
Yes, the rebalancing protocols and the specific triggers. because that externalizes the decision-making process completely.
I was looking at the Morningstar IPS worksheet while prepping for this deep dive, and it forces you to answer questions that, honestly, most people actively avoid thinking about.
It makes you face the math.
Exactly. It asks things like, what is the maximum percentage loss I am willing to accept over a rolling 3-month period or over a 1-year period? You can't just write, I'll write it out. You have to write down an actual percentage
Or
number.
you have to quantify the pain.
And even more powerfully, you have to define your execution triggers. You literally write down, if my equity allocation drops 15% below my target, I am required to do X. Or if the market drops 30%, I am required to do Y.
And what's really fascinating here is the massive psychological relief this provides when the storm actually hits. When the wealthy face a market crash, they aren't sitting in front of a Bloomberg terminal agonizing over what to do in real time.
Right, they aren't sweating and panic reading the news.
No, they aren't trying to process macroeconomic data using degraded cognitive reasoning while their portfolio bleeds out. They just open their desk drawer, pull out their IPS, and they act as an administrator.
An administrator, that's a great way to put it.
Yeah, they just execute the instructions they wrote for themselves 2 years ago.
It's the classic Greek myth, right? The story of tying yourself to the mast of the ship.
Oh, right, with the sirens.
Yeah, the captain knew that when he heard the siren's song, his mind would be completely compromised. He knew he would steer his ship into the rocks to his death. So he pre-committed his actions. He had his crew plug their ears with wax and physically bind him to the mast, giving them strict orders not to untie him no matter how much he begged or screamed.
Which is such a perfect metaphor.
Oh, yeah.
The IPS is literally tying yourself to the mast.
It really is. And this brings up the mechanics of rebalancing, which, as we saw in the American Century Investments research, is really the engine of the IPS. It's a crucial yet deeply misunderstood tool.
And it's also an immense source of psychological tension.
Because rebalancing essentially forces you to do the most unnatural thing possible, right? You have to systematically sell the assets that have gone up, the ones making you feel like a genius, and use that cash to buy the assets that have just crashed, which feel like toxic waste.
Right. It goes against every instinct. And occasionally you'll hear financial commentators describe this incorrectly, using really complex jargon. You might hear someone say, rebalancing introduces negative convexity to a portfolio.
Which sounds very intimidating.
It does, but we need to be precise here. True negative convexity usually applies to callable bonds or mortgage-backed securities where the price behaves inversely to what you'd expect as interest rates change.
Right, so what are we actually doing when we rebalance?
When we talk about rebalancing a standard equity and bond portfolio, what we're really doing is systematically stepping into the path of a falling knife. We're forcing a buy low, sell high discipline without ever having to predict market tops or bottoms.
But the American Century research actually provides a massive caveat about doing this during a crisis, don't they?
They do, yes.
Because they note that during extreme market stress, the underlying mechanics of the market itself kind of break down. Transaction costs spike and liquidity just evaporates.
This is a vital mechanical point. In a normal, calm market, setting tight rebalance bands works beautifully. Let's say your IPS dictates a 60% stock and 40% bond split with a really tight 2% drift tolerance.
Meaning, if a bull market pushes your stocks up so they now make up 62% of your portfolio, you immediately sell that excess 2% and buy bonds to reset back to 60-40.
Correct. And in normal times, the markets are highly liquid. The bid-ask spreads, which is the difference between what a buyer is willing to pay and what a seller is demanding, are pennies apart. And trading is practically free.
Right, it's seamless.
But during a high volatility crash, like what we saw in March 2020 during the early pandemic panic, the market plummeting clogs up. The bid-ask spreads blow out massively. Even assets universally considered completely safe, like investment-grade corporate bonds or even U.S. Treasury bonds, can suddenly become highly illiquid.
Wait, Treasury bonds? Really?
Yes. There are actual moments when there are literally no dyers on the other side of the trade.
So if you stick to your tight 2% rebalancing band during a historic crash like that, you are going to get chopped to pieces.
Absolutely chopped to pieces.
Your portfolio will trigger a rebalance every other day as the market swings wildly. And you'll be forced to sell assets into a market with massive spreads, eating terrible transaction costs and locking in slippage every single time you trade.
Which is exactly why the research suggests a dynamic approach within your IPS. During a systemic crash, it is actually mathematically superior to loosen those bands. You might widen your tolerance to a 5% or even a 7% drift.
Oh, I see. So your pre-written IPS would explicitly state something like, under normal volatility levels, I rebalance at a 2% drift. But if the market enters a defined high volatility regime, I widen my tolerance to 5% drift before taking any action.
Exactly.
You've literally solved the puzzle of transaction friction before the game even begins.
You really have. You've removed the emotional loop of wondering, oh, should I wait to trade? Is the spread too wide today? The policy just dictates the action. But, and this is a big go, executing an IPS effectively requires you to actually have the right tools in your portfolio.
Meaning what, exactly?
Meaning, you can't buy depressed assets if you don't have capital.
Ah, Which brings us right into the next structural pillar of the Wealthnetic mindset. If the IPS tells you what to do, what actual tools do you need to execute it without taking massive losses? This leads us to liquidity positioning and this concept of the strategic reserve.
And this completely upends how most of us are taught to think about cash.
It really is a fundamental paradigm shift because for the average retail investor, cash is simply a byproduct. It is whatever happens to be left over in the checking account after the mortgage and the credit cards are paid for the month.
Right. It's viewed as idle, lazy money. Or at best, it's a modest emergency fund sitting in a savings account meant to fix a broken transmission on your car or a leaky roof.
But the 1% view cash entirely differently, don't they?
Completely differently. They view it as a dedicated, permanent, structural asset class.
I always think of this like playing a massive real-time strategy video game like StarCraft or Age of Empires.
That's a good analogy.
Yeah, because if you spawn into the map and you immediately commit every single one of your troops to the very first skirmish, you might win that specific battle, but you have 0 reserves left.
Right.
So when the enemy inevitably flanks you, or the rules of the engagement suddenly shift, you are completely defenseless. Holding back a strategic reserve of resources from the current engagement isn't wasting them. It's preserving your optionality. You are holding back the power to dictate terms later in the game.
That is an excellent mechanical way to look at it. The breakdown from the 8-bit economics video makes this point brilliantly, but they also acknowledge the psychological difficulty of actually doing it. Well, it's incredibly hard. It is. Because in a multi-year roaring bull market, holding a large cash position is mathematically a drag on your portfolio's performance. It is just a documented fact. Cash does not compound the way equities do. It constantly loses purchasing power to inflation. And frankly, people will mock you for holding it.
Oh, absolutely they will. I mean, if you were sitting on a 10% cash reserve in a money market fund yielding maybe 4%, while your neighbor is bragging at a summer barbecue that his tech-heavy S&P 500 index fund is up 25% for the year, you feel incredibly foolish.
You do. It feels like you are actively losing.
But in a crash, the entire paradigm flips overnight.
It flips instantly.
Yeah.
Cash suddenly transforms from a depreciating drag into the rarest, most powerful, and honestly, most aggressive asset on the board.
And why is that?
Because it is the only asset that definitively prevents forced selling.
Let's walk through the exact mechanics of forced selling because this is where the average investor really gets wiped out. When markets drop 30%, assets don't just lose value on a computer screen.
No, they become toxic. If an individual is 100% invested in equities and a recession hits, they are highly exposed to a very dangerous chain reaction. Let's say their portfolio drops 35%. Simultaneously, because it's a recession, they lose their job.
Which happens all the time.
Right. Or if they're using leverage, their broker issues a margin call, suddenly they need physical liquidity, actual USD in their account to survive, pay their mortgage, or satisfy the broker.
Let me stop you there because we need to define that. Walk me through the actual mechanics of a margin call for someone listening who has never used leverage. How does it actively crater a portfolio?
Certainly. So let's say you have $100,000 USD in cash. You open a margin account, and the broker lends you another $100,000.
Okay.
You buy $200,000 worth of stock. Your equity is 50%. The broker has a rule. Your equity cannot fall below, say, 30%. If the market crashes and the value of that stock drops from $200,000 down to $130,000, your loan to the broker is still $100,000.
Right, that doesn't change.
Exactly.
Yeah.
That means your actual equity is only $30,000 out of the $130,000 total value.
Yep.
You've breached their limit. The broker issues a margin call, demanding you deposit cash immediately to bring your equity back up.
And if you don't have a massive cash reserve sitting around?
The broker doesn't wait. They will forcibly liquidate your stocks at whatever the current market price is, which is probably the absolute bottom of the crash to pay off their loan.
Wow.
Yeah, you don't get a say in it. They sell your assets at a devastating loss, locking it in permanently. You have taken what was a temporary paper drawdown and converted it into a permanent destruction of capital.
That is brutal, but if you enter that exact same macroeconomic crash with a pre-allocated structural cash reserve, a strategic reserve, that entire chain reaction stops before it even starts.
Exactly.
You lose your job. You pay your mortgage from the reserve, the market drops. You don't have to sell a single share of your depressed index funds. You just wait it out.
You can wait. Or, as the 1% do, you can actually go on the offensive. Because you hold the liquidity that the rest of the market desperately needs, you get to dictate the terms. You can deploy that cash to buy up those violently depressed assets from the people who are being subjected to those margin calls.
That is the true power of liquidity positioning.
It really is.
Yeah.
The 8-bit economics channel points out that this isn't just about keeping 3 months of living expenses in a high-yield savings account. It's about maintaining a meaningful, calculated percentage of your total net worth, sometimes 10% to 20%, depending on where we are in the cycle in assets that can move instantly.
Now, I want to play devil's advocate here for a second, because if we look at the source material from Wilmington Trust's cash investing playbook, they specifically warn against the danger of holding too much cash while waiting for a pullback.
They do, yes.
They ran all these historical models on strategies for deploying large windfalls, like if you sell a business or receive an inheritance. And the data definitively shows that historically, taking all that cash and investing it into the market on day one as a lump sum is more profitable, roughly 65% to 70% of the time, compared to slowly dollar cost averaging it into the market over, say, 12 or 24 months.
That is a critical data point, and we absolutely have to address it.
Yeah.
Because the mathematics of the stock market dictate that since equities have a general upward drift over long periods of time, getting your money exposed to compounding as early as possible is the mathematically optimal strategy.
Right.
Wilmington Trust's research shows that severe pullbacks are relatively rare. If you sit on the sidelines in cash waiting for a 20% crash, you will very often miss out on a 40% gain while you wait.
Oh,
And
right.
by the time the 20% crash finally happens, you are still buying in at a higher price than if you had just invested on day one.
Yeah. So how do we reconcile this? We have Wilmington Trust with the math saying invest immediately, but the Wealthnetic architecture we are discussing mandates holding massive strategic reserves of cash. Are those completely contradictory ideas?
They appear contradictory only if you assume the primary goal is to optimize for the highest possible theoretical return. But the 1% architecture doesn't optimize for theoretical maximums, it optimizes for survivability.
Survivability over maximum returns.
Exactly. We reconcile this through the lens of psychology and structural safety. Wilmington Trust themselves acknowledge that while an all-in lump sum strategy has the highest average return, it also possesses the widest dispersion of potential outcomes.
What does that mean, dispersion of outcomes?
It means it carries the largest potential for catastrophic short-term losses if you happen to invest right before a black swan event.
Oh, I see. If investing all your cash at once is going to cause you so much psychological distress that you panic sell the moment the market dips 10%, then the mathematically optimal strategy is actually a complete disaster for you.
Precisely. Furthermore, a strategic reserve is not a market timing mechanism. You are not holding 100% of your net worth in cash waiting for a crash. You are maintaining a specific dedicated allocation of cash, say, 10%, as a permanent fixture of your portfolio design. It acts as a shock absorber for the other 90% that is fully invested in actively compounding.
Okay, that makes perfect sense. The cash is like the watertight door on a submarine. It doesn't help you go faster, but it ensures you don't drown if the hull breaches.
That's a great visual.
And speaking of structural safety, that leads us perfectly into the next pillar. If cash is the shock absorber, what is the actual engine? This brings us to concept 4, uncorrelated income architecture.
Yes. When retail investors think about safety and risk mitigation, their immediate reflexive answer is always diversification.
Of course, don't put all your eggs in one basket.
Right. The standard advice is to hold a wide mix of assets. U.S. large-cap stocks, international equities, emerging markets, maybe some real estate investment trusts, and a ladder of corporate bonds. The theory is that if one sector zigs, another will zag.
But the 8-Bit Economics Deep Dive points out a terrifying reality about traditional diversification during a true systemic crash.
It completely fails, or at the very least, it utterly fails to provide the absolute protection people have modeled to expect. During a severe liquidity crisis, think the great financial crisis of 2008 or the COVID crash of March 2020, we see a phenomenon where correlations basically spike to 1.
Explain the mechanics of correlation for a listener who might not look at these metrics daily. Why do things that are supposed to move independently suddenly drop together?
Well, correlation measures how two assets move in relation to each other. A correlation of 1 means they move perfectly together. A correlation of -1 means they move perfectly opposite.
Okay, so far so good.
In a normal market, international stocks and U.S. corporate bonds might have a very low correlation. But during a systemic panic, institutional investors face massive margin calls across their entire books. To raise cash, they are forced to sell everything.
Oh, I see.
They sell their gold, they sell their emerging market tech stocks, they sell their municipal bonds.
So the correlations converge. Suddenly, your beautifully constructed, globally diversified portfolio doesn't protect you at all. Your international stocks drop 30%, your U.S. tech stocks drop 35%, your safe corporate bonds take a 15% hit. There is literally nowhere to hide. You are fully exposed to the macro environment.
Which is exactly why the 1% build true structural resilience, not just through asset diversification, but through uncorrelated income streams.
That's the key right there.
Yeah, they don't just own a wider variety of paper assets. They build or acquire income streams whose cash flows are dictated by mechanisms entirely separate from the global financial markets.
We need to give some real-world examples of this. If I'm building a normal USD portfolio, what does a watertight bulkhead of uncorrelated income actually look like in practice?
It looks like establishing a small-side business that serves a hyper-local or niche need. It looks like owning a duplex with long-term stable tenants. It could be monetizing a freelance skill like copywriting, consulting, or graphic design, or it could be earning royalties from intellectual property, like a book or software you created.
Right, so if the S&P 500 has a horrific Tuesday and drops 5% just because the Federal Reserve chairman coughed during a press conference, your freelance consulting client doesn't suddenly refuse to pay your invoice.
Exactly.
Your tenant in the duplex still pays their rent on the first of the month. The income continues flowing regardless of Wall Street sentiment.
Now, to be perfectly clear, in a massive, prolonged, deep recession, Those cash flows might compress slightly. Rents might stagnate, or consulting contracts might take longer to sign, but they do not gap down to zero overnight on a Tuesday afternoon just because of a bad earnings report from a semiconductor company.
That's a huge distinction.
Having that uncorrelated cash flow physically arriving in your checking account changes the entire psychological experience of a stock market crash.
It changes the math of survival, which ties into a huge concept we see in the research from McKinsey Investments regarding retirement planning. They focus heavily on something called sequence of returns risk. Can you break down how uncorrelated income solves that specific nightmare scenario?
Sequence of returns risk is really the single greatest threat to a retiree. Imagine two investors, both retiring with a $1 million USD portfolio, both needing to withdraw $50,000 a year to live.
Okay, exact same starting point.
Right. Investor A retires in 1999. Investor B retires in 2003. Over the next 20 years, they experience the exact same average market returns, but Investor A gets hit with the dot-com crash in their very first year of retirement.
So their $1 million portfolio drops to, say, $700,000 right out of the gate, but they still have to pull out their $50,000 to buy groceries and pay property taxes.
Precisely. They are withdrawing $50,000 from a depleted $700,000 base. They are eating into the principal so deeply at the absolute bottom of the market that even when the market eventually recovers, they don't have enough capital left to compound. Investor A runs out of money and goes broke.
Wow. And Investor B?
Investor B, who experienced the good years first, is completely fine. That is sequence of returns risk. It's all about the timing of the bad years.
So how does the uncorrelated income stream fix this?
Well, if Investor A has a rental property generating $25,000 a year, and maybe a freelance consulting gig generating another $25,000, their living expenses are entirely covered by uncorrelated cash flow.
Oh, so when the year 2000 crash hits, they don't have to sell anything.
Exactly. They don't sell a single share of their depressed portfolio. They preserve their principal, completely negating the sequence of returns risk. They rely on the bulkheads instead of the sinking ship.
That is structural architecture at its absolute finest. Which brings us perfectly to the next psychological pillar. We've talked a lot about the math, but the book, The Psychology of Money, introduces a concept that just completely changed how I view financial planning. It's the critical difference between a rational plan and a reasonable plan.
This is one of the most profound distinctions in all of behavioral finance. A mathematically perfect, hyper-optimized, rigorously rational financial plan is completely, utterly useless if it is so rigid or so volatile that you abandon it during your very first moment of panic.
I always compare this to extreme fitness. It's like going on an ultra-strict diet where you weigh every single gram of food and you eat absolutely nothing but steamed broccoli and boiled chicken breast for every meal.
Right, the bodybuilder diet.
Yeah. Mathematically, physiologically, rationally. You will lose body fat and hit your macronutrient goals. But practically, humanly, you are going to crack. By day 6, the psychological deprivation will trigger a massive binge and you will eat 2 entire pizzas.
That is a very, very accurate parallel. The author advises investors to deliberately craft a pretty reasonable strategy rather than striving for an ultra-rational one.
A reasonable plan.
Right, a plan where you eat healthy 80% of the time, but allow yourself a burger and a beer on the weekend. It is vastly superior because you will actually stick to it for a decade. The financial plan you can stick with, through thick and thin, bull and bear, is honestly the only plan that matters.
And to build a reasonable plan, we really have to look deeply at how we define and tolerate risk. The source material from Passive Investing Australia, specifically their deep dive into debt recycling and portfolio construction, breaks risk tolerance down into 3 distinct measurable buckets. I want to spend some time here because this is incredibly helpful. The 3 buckets are the ability to take risk, the need to take risk, and the willingness to take risk.
Let's start with ability.
Yeah, how do we define that?
Your ability to take risk is an objective mechanical constraint. It is primarily dictated by your time horizon and your current earning capacity. The fundamental question is, if this investment goes badly, is there enough time for the asset to recover before you are forced to liquidate it to buy groceries or fund a goal?
Okay, so if I'm saving up for a down payment on a house and I absolutely need that $50,000 USD in 12 months, my ability to take risk is literally 0.
Absolute 0.
I cannot put that money into the S&P 500 because a 20% drop means I can't close on the house and I have no time to wait for the market to bounce back. But if I'm 30 years old and I'm saving for a retirement that is 35 years away, my ability to take risk is massive.
Exactly. The source material quotes some established guidelines from a well-known financial researcher to make this concrete. For an investment horizon of 0 to 3 years, your maximum equity allocation should be 0%. It belongs in cash or short-term treasury bills. By a 10-year horizon, you have the ability to hold perhaps 70% in equities. For 20-plus years, you theoretically have the objective ability to be 100% in growth assets.
Okay, so that's the mechanical ability. What about the need to take a risk? How do we calculate that?
Need is a pure mathematical calculation based on your future liabilities. How much return do you actually require to meet your specific financial goals?
Can we walk through the math on that?
Sure. Let's see you calculate that. Based on your desired lifestyle, you will need $40,000 a year in retirement income. above and beyond whatever pension or Social Security you receive. If you plan to use the standard safe withdrawal rate of 4%, you mathematically need a $1,000,000 USD portfolio to generate that $40,000 safely.
Okay, I follow the math. So 1 million is the target.
Right. So based on how much capital you have right now and how much you're able to save each month, what rate of return is required to cross that $1,000,000 finish line by your target date? If you plug the numbers into a compound interest calculator and realize you need a 7% or 8% annualized return to hit your goal, you have a high need to take risk.
Because bonds won't get you there.
Exactly. You literally must hold a heavy allocation of equities because bonds or cash will never generate 8%.
But on the flip side, if I'm already wealthy or if I have a massive savings rate, say I'm saving 50% of my income, and the math shows I only need a 3% annualized return to hit my goals, my need to take risk is incredibly low.
Very low.
I could just buy a ladder of municipal bonds, earn my 4% tax-free, and sleep soundly. I don't need to expose my capital to the volatility of the stock market.
Precisely. If you have won the game, stop playing. Don't take risks you don't need to take just to maximize a spreadsheet. But that brings us to the third bucket, which is the most critical, the most destructive, and honestly the hardest to quantify. The willingness to take risk.
Because willingness is the psychological component. It is your panic point.
Yes. Your willingness to take risk is your emotional capacity to endure high volatility without taking destructive action. Let's say your portfolio is perfectly aligned with your ability, you have 20 years, and you need 8% returns. So you are mathematically justified in holding a portfolio of 90% equities.
Makes sense on paper.
But if that volatility exceeds your willingness to see the dollar value drop, you will panic sell. And the tragedy is, if you panic sell at the bottom, your objective ability and your mathematical need become entirely irrelevant. You've permanently locked in your losses, and the plan is destroyed.
The source material specifically points out a fascinating trick for calculating your willingness. It warns that you should never think about willingness in terms of percentages because human brains just don't process percentages well. A 30% drop sounds abstract. It sounds like a math test.
Exactly. To test your willingness, you have to convert it into raw dollars.
Right.
If you have an $800,000 USD portfolio, you have to close your eyes and vividly imagine logging into your brokerage account on a Tuesday morning and seeing that the balance has dropped to $560,000. You have literally lost $240,000 in wealth. That is the price of a small house. Gone. Can you physically stomach that? Can you look at that number, close the laptop, go to work, and not sell a single share?
That's a gut check. And if the honest answer is no, if the thought of losing $250,000 makes you feel physically ill or makes you feel like you would sell everything to protect the remaining $500,000, then your portfolio is too aggressive.
It is too aggressive for your psychology.
You have to adjust your asset allocation to something more conservative right now while the market is calm, even if it means you will earn a slightly lower return over your lifetime.
This is exactly why taking financial cues or copying the asset allocation of your neighbor, your coworker, or someone on the internet is so incredibly dangerous.
Everyone's playing a different game.
They are. A 30-year-old day trader with no dependents has a wildly different ability, need, and willingness to take risk than a 55-year-old single parent preparing for early retirement. You have to craft an architecture that serves your specific psychological limits.
Okay, all of this theory is incredible. The mechanics of the IPS, the strategic reserve, the uncorrelated income bulkheads. It makes total rational sense on paper. But I really want to see this in action. I want to look at how this architecture actually performs in the real world when the macroeconomic sky is seemingly falling and billions of USD are on the line.
Let's do it.
Let's dive into some historical case studies. Story 1. The 2008 financial crisis masterstroke.
This is perhaps the most perfect modern illustration of the strategic reserve in action. We are looking at a legendary, world-renowned value investor. In the summer of 2007, heading into the absolute peak of the housing bubble, this investor's holding company was sitting on over $40 billion USD in cash on its balance sheet.
And the context here is vital because people were actively laughing at him. The financial press was writing op-eds saying he had lost his touch, that he didn't understand the new economy.
Right, the era of easy money.
We were in the middle of one of the most euphoric bull markets in history. Everyone on Wall Street was getting obscenely rich flipping houses, leveraging up 30 to 1, and buying exotic mortgage-backed derivatives. And this guy is just sitting on a mountain of $40 billion in cash, earning a paltry yield in short-term bills. It was viewed as a massive, embarrassing drag on his returns.
But we have to understand his architecture. He wasn't sitting on that cash because he had a crystal ball predicting the subprime mortgage collapse. He was simply adhering to a pre-committed, unbreakable structural rule. Always maintain massive, unquestionable liquidity.
The structural rule.
He viewed that cash not as idle money dragging down his returns, but as a loaded option. He famously operated under the principle that he never, ever wanted to count on the kindness of strangers, meaning banks or credit markets, to meet tomorrow's financial obligations.
And then September 2008 happens. Lehman Brothers files for bankruptcy. The global financial system essentially suffers a massive coronary and freezes up. Credit markets completely shut down.
It was terrifying.
Major institutions that had zero margin of safety, that were running on maximum mathematical efficiency and 25-to-1 leverage, suddenly faced billions in margin calls and went completely bankrupt within days.
And in that exact moment, the paradigm flipped. Suddenly, the investor who was mocked for holding lazy cash was the only entity in the entire private market with the physical capital and the structural credibility to act as the lender of last resort.
The mechanics of how he deployed that cash are staggering. He didn't just buy index funds at a discount. He went to the most desperate, powerful companies in the world and dictated the terms of their survival.
She did.
He invested $5 billion USD into a massive investment bank. But he didn't just buy common stock. Walk us through what he actually demanded.
Because he held the ultimate strategic reserve, he negotiated incredibly favorable terms that no retail investor could ever access. He purchased $5 billion in preferred shares. Preferred shares sit higher in the capital structure than common stock, meaning if the bank went bankrupt, he would get paid back before the regular shareholders.
Which is safer.
Much safer. More importantly, these preferred shares paid a guaranteed 10% annual dividend.
So he's getting $500 million a year in pure cash flow, guaranteed, while the rest of the market is plummeting.
Exactly. But that wasn't all. As a sweetener for providing the lifeline, he also demanded stock warrants. A warrant is a derivative that gives you the right to buy regular common stock at a specific, locked-in price anytime in the next several years.
Oh, wow. So he gets the upside, too.
He secured downside protection and a massive 10% yield, while also capturing the explosive upside of the eventual market recovery. He did similar multi-billion-dollar deals with other massive industrial conglomerates, and eventually used his cash pile to buy an entire railroad company outright for $34 billion.
The lesson here is profound. The institutions that collapsed in 2008 weren't run by stupid people. They were run by hyper-intelligent people with armies of quantitative analysts.
They're the smartest guys in the room.
Exactly. They failed because their mathematical models optimized for maximizing daily returns in a calm market, and they treated the risk of a systemic liquidity freeze as a statistical rounding error. This legendary investor's architecture optimized for survivability first. That $40 billion in cash wasn't dead capital. It was the exact mechanism that allowed him to convert a systemic panic into generational wealth.
It perfectly illustrates your car crash analogy from earlier. The people without seatbelts went through the windshield, and the guy who put his seatbelt on in the driveway ended up buying the car factory for pennies on the dollar.
That is exactly it. Let's look at story 2, which takes us back a few years earlier to the dot-com crash, surviving with a margin of safety.
This case study is fascinating because observers often attribute this company's survival to pure luck. But when you look at the mechanics, it was pure structural architecture. In February 2000, exactly 1 month before the NASDAQ peaked and the dot-com bubble spectacularly burst, a famous tech founder raised hundreds of millions of USD for his e-commerce company.
And the specific vehicle he used to raise this money is crucial. He didn't just issue more stock, he raised the money via convertible bonds. Can you break down what a convertible bond is and why it was so significant?
A convertible bond is a type of corporate debt. Investors lend the company money, and in return, they get regular interest payments. However, the convertible part means that the investor has the option, down the road, to convert that debt into shares of the company's common stock at a predetermined price.
Why would a company choose this over just getting a regular bank loan or selling more shares?
It's often much cheaper. Because the investor gets the upside potential of converting to stock, if the company explodes in value, they are willing to accept a much lower interest rate on the debt.
I see.
For a fast-growing, cash-hungry tech startup, it provides a massive infusion of immediate liquidity without immediately diluting the ownership of the existing shareholders. At the time, in February 2000, it just looked like a standard, aggressive corporate financing move to fuel expansion.
But then, March 2000 arrives, the bubble bursts. Over the next 2 years, the NASDAQ loses nearly 80% of its value. This specific e-commerce company's stock falls 95%.
95%. Just incredible.
Hundreds of well-funded, highly publicized competitors burn through their venture capital, fail to raise more money because the capital markets have slammed shut, and go completely bankrupt.
They just vanished.
But this company was bleeding cash, too. They burned through over $1 billion in the year 2000 alone, just building out their fulfillment infrastructure. But they survived. Why? Because of that massive cash buffer they secured via those convertible bonds right before the crash.
Right.
The company's CFO later confirmed in interviews that without that specific massive capital raise, they likely would have run out of cash and died alongside everyone else.
But here's where we see the secondary generative effects of building a margin of safety.
Right.
It doesn't just act as a shield to protect you from bankruptcy, it acts as a springboard.
Precisely. Because they had the capital to survive the extinction event, they were able to continue building their massive digital and physical infrastructure while their competitors literally vanished. Years later, when they realized they had built excess computing capacity to handle holiday shopping spikes, they packaged that excess capacity and started selling it to other businesses.
which became their massive cloud computing infrastructure division, a division that fundamentally changed the internet and became a hugely profitable foundational pillar of their empire.
And that empire was built upon the structural resilience they forged during their survival period. The margin of safety allowed them to weather the crash, but it also provided the runway to invent the future.
That's a great way to look at it.
Okay, let's go even further back in time. I want to prove that this isn't just a modern phenomenon driven by the Federal Reserve or tech valuations. This is a timeless law of wealth physics. Story 3. The 1893 Steel Empire expansion.
This takes us into the heavy industry of the 19th century. We are looking at a historic industrialist who ran his massive steel empire with a fanatical, almost pathological, strict zero-debt policy.
Zero debt in heavy industry.
Yes, this was highly unusual and heavily criticized at the time. His competitors were borrowing heavily from banks to fund aggressive expansions, leveraging their balance sheets to build more blast furnaces and grow market share faster.
Because in a booming economy, leverage amplifies your returns. If you can borrow at 5% and generate a 12% return on a new steel mill, you borrow as much as you possibly can.
Exactly, until the music stops. And the music stopped violently with the Panic of 1893.
Yeah.
This was the worst economic depression in American history up to that point. It was triggered by railroad overbuilding and a run on the gold supply.
Yeah.
Bank runs were rampant, over 500 banks failed, and credit markets completely froze up.
In heavy industry, like steel manufacturing, you have massive fixed costs. You have to pay to maintain the furnaces, pay the workers, and buy the coal, regardless of whether anyone is buying your steel.
Right, the furnaces can't just be turned off easily.
When the Depression hit, railroad construction halted and steel demand fell off a cliff. Prices dropped below the actual cost of production.
This is where the structural vulnerability of his competitors became fatal. They were saddled with immense debt payments. When the revenue collapsed, they couldn't service the debt. And because the banks were failing, they couldn't refinance their loans.
They were trapped.
They were forced into distress. They had to sell their assets, their foundries, their coal mines, their rail lines at catastrophic 80% discounts just to meet payroll. Or they were forced into bankruptcy and liquidated.
But our industrialist had zero debt. He had a pristine, unencumbered balance sheet and massive reserves of physical cash. He didn't have to worry about the banks calling his loans because he didn't have any, so he went on a massive offensive.
He used his liquidity to buy up his bankrupt competitors at rock bottom, pennies on the dollar prices. While everyone else was liquidating, he expanded his production capacity, buying land and building new mills when construction costs and labor were at their absolute historic lows.
By the time the macroeconomic depression finally ended and the economy recovered, his steel empire had doubled its total capacity. His rivals were either dead or still limping along trying to repair their shattered balance sheets.
It was total dominance.
When he eventually sold the company a few years later in one of the most famous transactions in history, a sale for hundreds of millions of dollars, which translates to tens of billions in today's money, he personally controlled a quarter of all American steel production.
This story perfectly encapsulates the foundational concept of the margin of safety from the father of value investing. The reality of investing and business is that every estimate you make is wrong. Your revenue projections will be wrong. Your timeline will be wrong.
Always.
Always. A margin of safety, whether it's zero debt or a massive cash reserve, exists entirely to absorb the errors in your analysis. It absorbs the surprises you didn't model and the terrible luck you couldn't possibly foresee.
Like a structural buffer.
To use an engineering metaphor, you build a bridge to hold 100 tons of weight, even when you only ever expect 50 tons of traffic. That extra 50 tons of structural capacity isn't a waste of steel, is the reason the bridge survives the unexpected hurricane.
Okay, we have seen how the Titans do it. We've seen the 1% architecture in action across 3 different centuries. But how do you, the listener, driving to work or walking the dog or sitting at your desk, apply this to your own life today? Let's pivot to the Wealthnetic action phase. Let's translate this high-level institutional theory into 4 practical, actionable takeaways you can implement for your own USD portfolio right now.
Takeaway number 1. Draft your own pre-commitment rules. You need to create your own investment policy statement.
Don't just think about it. Don't just make a mental note. Open a document and write it down. Define your target asset allocation and your specific rebalancing triggers today while your C system is fully engaged and you are perfectly calm. Write down exactly what you will mechanically do if your portfolio drops 15%, 30%, or 50%.
If you decide to hold a portfolio of 60% broad market index funds and 40% treasury bonds, set a rigid rule. Write down. If my equity allocation drifts to 65% during a bull market, I will sell the excess and buy bonds. If the market crashes and my equities drop to 55%, I will sell bonds and buy equities. Set your wideband rules for high volatility environments as well.
And once you write it, put that piece of paper somewhere physically visible or save it on your desktop. When the market inevitably gets turbulent and the financial news network is flashing red, do not try to outsmart the market.
Stick to the plan.
Refer to the document. Let your rational Spock brain that wrote the document dictate your actions, not the panicked McCoy brain that is currently experiencing the adrenaline spike of the drop.
Which leads directly to takeaway number 2. Perform the dollar value stress test. This is how you ensure the IPS you just wrote is actually survivable.
This is critical for discovering your true, honest willingness to take risk. You have to stop thinking in abstract percentages.
Yes. If you have a $100,000 USD portfolio and you are trying to decide if an 80% stock allocation is right for you, don't ask yourself, can I handle a 40% drawdown? That engages the math brain, and the math brain will confidently say, yes, I understand historical volatility.
But the mass brain isn't the one who panics.
Exactly. Instead, translate it. Ask yourself, how will I feel when I log into my account on a Thursday night and I see that my hard-earned balance is now $60,000? I have literally lost $40,000. That is a year's salary vaporized.
If visualizing that specific reality makes your stomach knot up, if it makes you feel like you wouldn't be able to sleep, or worse, that you would panic and sell everything to protect the remaining $60,000, then your portfolio is too aggressive.
Way too aggressive.
You need to adjust your asset allocation right now, today, before the drop ever happens. Move to a more conservative mix of stocks and bonds that aligns with your actual psychological tolerance, so that a 50% market crash only results in a dollar value drop you can actually stomach without flinching.
Takeaway number 3, reframe your emergency fund. We need to completely upgrade how we view liquidity.
Stop looking at your cash savings as idle money. That is just sitting there being lazy and losing purchasing power to inflation. That is a first-order way of thinking that leaves you vulnerable.
Reframe it as a strategic reserve. It is an active, aggressive position on your personal balance sheet. It is the seatbelt. It preserves your optionality. It ensures that if a macroeconomic crash causes you to lose your job, you aren't forced into the devastating cycle of selling your depressed investments to pay rent.
It prevents forced selling.
It physically protects you from crystallizing your losses. Think of that cash not as a drag, but as a loaded option, waiting for the precise moment when liquidity becomes the most valuable asset in the world.
And finally, takeaway number 4, build one uncorrelated income stream. This is how you build the watertight bulkheads.
Remember the lesson on correlations. True resilience isn't just owning 500 different international stocks instead of 50 domestic stocks. During a severe systemic panic, they will all go down together. True structural resilience comes from developing cash flow that operates completely independently of the financial markets.
Start developing a freelance gig, a consulting skill based on your day job, a small digital side business, or look into acquiring stable rental real estate. It does not have to be massive.
It doesn't have to replace your full-time income at all.
But having a reliable, recurring stream of cash, even an extra $1,000 a month that fundamentally does not care what the Federal Reserve or the S&P 500 is doing, changes the entire psychology of a downturn.
It acts as an emotional anchor. It provides physical proof that the world has not actually ended, that commerce is still happening, that money is still exchanging hands, and most importantly, that your survival is not entirely dependent on the whims of Wall Street. It completely neutralizes the sequence of returns risk if you are nearing retirement because you have alternative capital to draw from.
It all comes back to architecture. Wealth generation might rely on compounding in time, but wealth preservation is entirely about the decision architecture you build around it. Financial resilience is built during the times of calm, not activated during the chaos. You put the seatbelt on in the driveway.
And that leads to a critical realization about managing your own money. As the behavioral research points out, a robust, pre-committed investment process is vastly more important than short-term results.
Because you can't control the result.
You cannot control the macroeconomy. You cannot control inflation or interest rates or the decisions of tech CEOs, but you can entirely control your process, your discipline, and your structural architecture.
So as we wrap up this deep dive into the Wealthnetic mindset, I want to leave you with one final provocative thought to mull over. It's a question that challenges the very foundation of how most retail investors handle their money.
Look closely at your current financial setup, your portfolio, your cash reserves, your income sources, and ask yourself this brutally honest question. If my entire financial plan relies on me making perfectly rational, emotionless, Spock-like decisions on the worst, most stressful, most panic-inducing day of my life, do I actually have a plan?
That is the ultimate question. The 1% know the answer to that is a resounding no, which is exactly why they build the resilient, pre-committed structures we discussed today. If this deep dive shifted how you see your own wealth architecture, we warmly invite you to subscribe to the Wealthnetic channel. Share this with a friend or a family member who might need a mindset shift from reacting to the news to structurally preparing for it. And please dive into the original source materials we discussed to keep building your financial resilience. Keep that seatbelt securely fastened, keep building your watertight bulkheads, and we will see you on the next deep dive.